how standard deviation captures market volatility. Should be a good one.
Does it?
This should be a good one.
Check
How
it out.
standard deviation captures market volatility. Let's see what we got here. This is our market measure. We often use the term standard deviation. You'll hear it all the time on Tasty. And recently, we've received questions from our viewers asking how standard deviation can capture market volatility. I'm curious to see how they're going to say this. So today, we're going to define what it means and apply it in context to some notable market moves, meaning we're going to go back in time and we're going to look at some periods that were outside the normal range and some that were inside the normal range. Intuitively, a standard deviation tells you how spread out the data is. In other words, the standard deviation is the value that tells you by how much, on average, you can expect a single data point to be away from the mean of the data set. So what does this have to do with trading? It took me a long time to figure this out too. I hated when I was on the trading floor and I'd go upstairs and some risk manager would go, here are 2 standard deviations away. I'm like,
what is a standard deviation?
I didn't really do well in statistics. This was the early 80s. I hated statistics. Let's go to the next slide. What does it have to do with trading? So in trading, we use standard deviations to gauge how close the next value is going to be to its average. So the S&P 500 has a daily standard deviation of 1.2 and 1.1% in 1995 and 2015, respectively. This means that 68% of the time, the day's change will fall between the mean plus 1.1 and the mean minus 1.1 since 2015. That's why we like to use just 1%. It's just easier. And you can see here how it's changed over a long period of time, almost 30 years. Not much. It's pretty consistent.
Pretty consistent, yeah. I mean, 0.04 to 0.05, yeah, I would say it's pretty consistent.
Let's go next slide. Now let's use the concept of standard deviations to show how some dull and volatile periods of trading have actually been. Let's go next slide. S&P 500, we observed volatile periods, dull periods, and long-term averages since 2015. We took the dull periods, the volatile periods, and we computed the standard deviation of all periods. Note, the period with the highest standard deviations are the most volatile ones. So in dull periods of market movement, we see that the overall standard deviation and therefore the price volatility of the market is roughly 1/3 less than the long-term averages. And again, what we did here is we took different periods. The 2017, which was the quietest period we've ever seen. We didn't have a move all year of over 1%.
1%, do you imagine that?
That was Trump's really first full year. And shockingly, there was no volatility. 2019.
You least expect it,
Yeah,
right?
exactly.
I mean, yep.
2019, something very similar. 2021 post-COVID, 2023, and then 2024. And you can see the standard deviation. This is for a 10-year period from 2015 to 2025. And you can see the standard deviation these were just the dull periods when the daily percent change was low. Yep. We didn't move much.
Yep, didn't move at all.
Those were good years for premium sellers. And volatility was cheap in those years too. Here are the big years. On average, in volatile periods, we see that the standard deviation is roughly 60% larger than in all environments and roughly 3 times larger than the dull periods. So 2015, 18, 20, 22, 23, and 24, different periods at this time, we were over the 1% number. And you can see the COVID crash was 4.5%. 4.5%, almost impossible to defend, just so you know. 1.3, 1.5, 1.5, 1.2, 1.2, all periods where you can defend that because that's the business that we're in. Sometimes the stock wins 4.5%, indefensible. When we think about this, where we are where we are with respect to standard deviation and market volatility, standard deviation gives us context around the probability of experiencing a certain move away from the mean. Do you know what we worry about? We worry about moves over 2 or 3%. because that's where it starts to get. The brokerage firms are protected on moves of 2%, a little over 2%. When it gets over 3%, things get a little hairy. Over 4, 5, or 6, 7%, things get tough.
Yeah, but as a trader, what we're looking for is less than that.
Less than
standard deviation.
we look,
right?
we look at the 1 standard deviation move, which is the most helpful for us. But we'll also look at 2 standard deviation because that's why on the platform we have CVAR, conditional value at risk, because that's where the 2 standard deviation starts to kick in. The 3 standard deviation, we can't really quantify that. So for roughly normally distributed data sets, such as market returns, we expect 1 standard deviation to encompass 68% of the data set moves. But we also expect that number to be significantly higher when you have limited profitability and unlimited risk. So based on standard deviations, 2020 proved to be almost twice as volatile as 2008, which is crazy. But currently we find ourselves in a volatile period. The level of volatility is approximately 3 times greater than the dull periods. And interestingly, from September 2024 to present, standard deviation of the S&P's daily percentage range has matched the average standard deviation observed over the last 30 years. So we're right in the middle of things.
What would you have thought? Would you have thought you were right in the middle of the last 30 years?
Yeah.
I would have thought we were a little bit greater. Just,
Okay, I'll give you that.
Yeah.
Okay,
Yeah.
I'll give you that.
Yeah.
Yep.